Last year, I made over $3 million trading prop firms. I've had some of the biggest payouts in the industry, period. And it's not because of one indicator I've magically kept. It's not because of a bot. It's because of one thing that most traders butcher: entry. You could have the right bias, you could have the right insight, you could have the right everything. But if your entry's bad, you'll get stopped out every time. Then you'll revenge trade and blur accounts over and over again. Trust me, I've seen it happen with myself. So today, I'm giving you my full entry model, the exact way I enter the market. We're talking about FVGs, IFVGs, and even golden. If you watched my last video where I broke down the ORM strategy, higher time frame analysis, overnight price, and the opening range move, this is part 2. This is where we go from learning how to read a chart to executing. The $3 million entry model.
Looking to get funded? Smart Prop Firm is your all-in-one platform for exclusive deals on top futures prop firms. Get the best discounts available and earn smart points to redeem free evaluations. Plus, get a free eval every month with our payout bonus when you trade with top prop partners like Lucid and Tradeify. Visit smartpropfirm.com through the link in the description to maximize your trading benefits.
2 steps to every trade. Step 1. Know where higher time frame analysis gives you your bias. The opening range move gives you the confirmation. 1. Higher time frame magnets, swing points, fair value gaps, inversion fair value gaps. 2. Overnight range, Asia and London sessions build the setup. 3. Opening range move confirmation, New York Open drives into liquidity. Step 2. Pull the trigger. How you get in determines your risk, your timing, and your edge. 1. FVG entry, patient, wait for the retest. 2. IFVG entry, aggressive, ride the inversion. 3. Golden entry, both stacked, highest probability. Let's get into it. Higher time frame recap. The roadmap. On the 4-hour and daily, we're fighting 2 things the target's price wants to reach. 1. Swing points, a large wick before a reversal. The market aggressively moves, creates a massive wick, then reverses. That wick is liquidity getting swept, market. 2. Fair value gaps. Fair value gaps and inversion fair value gaps created with displacement, aggressive, impulsive moves, and after liquidity was taken. Let's get into the graphics. You have an empty, plain chart with nothing drawn up on it, showing you exactly what a chart typically would look like if you just were to load in for the first time. And here is your after. This is how I mark out my higher time frame narrative, utilizing fair value gaps and inversion fair value gaps and swing points. Before, you had noise, now you have a roadmap. Let me show you a real example. Here is your 4-hour gap. But there's also one thing you guys aren't seeing. We have a 4-hour gap over here. Lanto, why mark 2 gaps in one zone? What does that even mean? Stay tuned for later. But here we go. We have a 4-hour bearish gap, and then we also have a 4-hour bullish gap at this point in time. This is where the markets have bottomed out. Now, Lanto, where are the swing points? Well, 1, you have here. 2, you have here. And 3, you have here. So we marked out the 4-hour. Have we acknowledged the daily yet? No. Let's take a look at it. The daily also had a fair value gap right here. You have a 1-day fair value gap where price comes back down into, alongside a 1-day previous bearish gap, which had turned a bullish inversion fair value gap. Stay tuned for later again. And now on the hourly time frame, we see an hourly fair value gap, which is large in displacement and has taken previous liquidity. So let's mark out this final gap here. As you can see, these swing points also hold value on every time frame, as we marked out these on the 4-hour, but these still hold validation on the hourly as well. So we've marked out our daily fair value gaps, we've marked out our 4-hour gaps, and we've marked out our hourly gaps alongside our swing point levels. Next step. The opening range move trigger. Layer on the opening range move framework. Wait for New York to sweep the overnight level, then watch for the reaction. 1. Asia/London. Sets the overnight range. Builds the trap. 2. New York Open. Drives it to Asia/London high or low. 3. The sweep. Initial move into overnight liquidity. 4. The reaction. Confirmation, the market shows its hand. The key insight. You now have your bias. You know where the higher time frame targets are. You now see the opening range move confirmation. Entry model now. So after marking out our higher time frame narrative, we now simply wait for the opening range move, which if you haven't watched the last video, we talk about our first move off our New York Open into an area of liquidity, typically Asia/London session high or low. This is a great visual example as you see an hourly gap get tapped into through a high, and then you see a bearish opening range move. Let me show you a real example on the charts. So now that we've identified what price has done via higher time frame, all we simply do now is wait for 9:30 a.m. and to see what price does off the open. Let's see how it goes. So here is your New York open. This is our New York open at 9:30 a.m. Now all we do for the opening range move is simply wait for price to react either off this London low or this London high. The reaction will confirm or deny our higher time frame outlook, which is for higher. So here you have it. You have your opening range move. After tapping this large higher time frame array, we see price come back up and we see price take out its London high. There's your initial move. Now the reaction. Let's see how the next candle reacts. And there you have it. We have an initial retracement candle followed by an engulfing bullish candle looking to trade past the London high. So what does that tell you? That tells you that price is clearly looking for a breakout past these London highs. So now that we've identified our higher time frame outlook via the rebalances with the arrays and the opening range move trade bullish, all we simply do is look for our entry model. 2 entries, that's it. The FVG entry and the IFVG entry. The FVG entry, the patient entry. Price makes an impulsive move, leaving an imbalance. Wait for price to retrace back into it. 1. Identify the imbalance. Price moves impulsively and leaves a gap, fair value gap, mark it. 2. Wait for a retrace. Don't chase, let price pull back into the imbalance zone. And 3. Enter the retest. Price proves the level holds. That's your entry. Pros and cons. Pros for an FVG entry is it forces you to be patient. There's no FOMO entries. It naturally is tighter, better priced entry. And 3, retest equals real confirmation that the level holds. Best for reversals. But it also comes with some cons. In strong moves, price may never retrace. The move can leave without you, and it can lead to forcing bad entries by widening the zone. Worse for continuation. So I will say FVG entries are great for both, but there are cons to either looking for reversal or continuation. Let's show you guys an example of both. So here's a good example. You have a fair value gap retest, and then you also have an inversion fair value gap retest. So what you're looking for price to do here off a fair value gap entry is you're looking for price to come down, retrace into the fair value gap, seek a rebalance in a healthy sequence where we bounce off the gap and look for higher. Here's what you don't want to see price do. You don't ever want to see price come down into an imbalance, see a bullish reaction, but then come right back down after. What you need is strong displacement in price. Let me show you an example. So now that we've identified our higher time frame outlook being bullish and the opening range move confirming our bias, what we're now simply looking for price to do is offer an entry in the market to ride into higher draw. Our higher draw targets become our higher time frame narrative because our lower time frame and higher time frame both have lined up. Let's see if we get one. Okay, so past the opening range move, price is looking for a breakout, potentially riding into this draw. What we're now looking for price to do is simply offer a retracement into a clear gap, which is displacive and or has taken out previous liquidity. What do we do here? We do both. Here is our marking, 1 minute gap. Same way we mark out higher time frame gaps. All we're now looking for price to do is retrace into the gap, which we have by touching and wicking the 1 minute gap. Now we're looking for a healthy candle to confirm interest in drawing higher here. Let's see if we get that soon. And there it is. There is your candle bouncing after seeing a retracement into the imbalance, confirming that, okay, now price wants to seek higher. Let's mark out the risk to reward and see how this trade pans out once you have entered this trade. So the stop loss I'm going to be using for this trade is our model stop, which is typically the fair value gap candle wick low or the fair value gap candle wick open. So we either go stop loss off the open of the candle or we go off the bottom of the candle. Let's see how this trade pans out. And boom, a beautiful move. We see target smashed eventually here where you see price come up and you see price run 24,244. So what do we have here? Higher time frame outlook being bullish by rebalancing off higher time frame arrays. Then you have your opening range move be bullish by coming out of the gap. And then we simply look for an entry in the market. Now this you would count as a continuation entry in the market. It has its cons, but it's still very effective. One key tip I'm gonna throw in the video is if you ever want to identify if you want to take a continuation model trade, simply look at the pace of price. You can see that clearly along the way coming into this opening range move. You see the pace of price and how strong it was in displacement by consistently seeing engulfing moves up and rarely retracing. Our first retracement since the open was right here after London had taken out liquidity, and what do you see price do? Immediately come right back up. And even off our entry, we see price come into this gap, barely tap the entry point, and then see it go. When price does that, it tells you that it's very bullish and it's trying to see higher now. The IFVG entry, the aggressive entry. An inversion fair value gap is a previous fair value gap getting disrespected. Price runs through it and flips direction. Previous bullish fair value gaps exists. Price was supposed to respect this gap going up. Price blows right through it. The old level is disrespected. That gap is now inverted. 3, the inversion equals your entry zone. Once it inverts and turns, you're in with the new direction. Pros and cons. Pros, speed. The market already showed its hand. 2, high follow through and probability from entry. And finally, perfect for trending continuation moves. Best for continuation. So here are a couple cons. On reversals, you could absolutely get faked out. Without enough data, your entry could be premature. Your entry could essentially just be a retracement in the market as opposed to a reversal. So here's another example. The inversion fair value gap entry. What you're looking for price to do is have an initial bullish gap, see price come down, disrespect it, turn it into a bearish inversion fair value gap, where you then see price come back up and invalidate that. So what I essentially mean is you're looking for a previous good bullish zone to turn bearish for price then to invalidate that bearish sequence, completely voiding that sell at all. So going back and using the same example, we initially marked out a fair value gap entry. Now let's mark out an inversion fair value gap entry. Well, right here, after seeing the opening range move occur, what you're looking for price to do after initially inverting the 1-minute gap is you're looking for price to what? Come back up and invert the bearish inversion fair value gap. So what do we see happen here? We see price 2 candles later come back up here and successfully seek a golfing closure back above the gap. So we see price retrace, invert the 1-minute gap, which is displacive, and also a gap in which took large liquidity being overnight highs, and then you see price come back up here. You see price going from a bullish fair value gap back to going into a bearish inversion fair value gap, where we then see price come back up and invalidate that bearish inversion fair value gap. So what do we do from here? We simply take entry in the market. Once price has confirmed, which for me is an engulfing candle closure above, you have your stops either placed the swing low, or you can be based off the second most recent swing low on the 1-minute time frame. Same objective. Mark out the high. What do we then see price do? We see price ultimately successfully run into that high utilizing an inversion fair value gap entry. And boom, there you have it. The cheat sheet, reversals. It's best for FVG entries. It's not the best for IFVG entries. Continuation. It's pretty risky for FVG entries, but it's a lot better off for IFVG entries. Fair value gaps for reversals, IFVGs for confirmation. Now, when I say this again, I don't mean don't take fair value gaps on continuation models, don't take inversion fair value gaps in reversal patterns, but I find the most probability through utilizing these two different things. Now, let's talk about the golden entry, the highest probability entry. Fair value gap plus inversion fair value gap in sync, 2 rebalances in 1 move, double confirmation. Number 1, 5-minute chart, fair value gap zone, price retraces into it. Step number 2, drops to the 1-minute time frame. Inversion fair value gap forms from inside the 5-minute zone. Number 3, execute. Let's take a look at this visual. So on this visual, where you have a chart showcasing 2 different arrays, what you're looking for is you're looking for a 5-minute array to sync up with a 1-minute array. So let me show you a real example that I took with my Discord live while trading this past Tuesday. So here is the example, potential in play, 1-minute IFVG trade, bullish setup. So here's the graphic off the initial idea. It was a 1-minute gap that went invert. All I was simply looking for a price to do was retrace, offer a rebalance, and then send higher. However, we then ended up seeing a 1-minute gap get formed after this inversion fair value gap had held its respect. You see price come back up, you see a closure over, and you see price ultimately come back down here and retrace with equal highs set in place. So this is it right here. You then see me mark it out and simply mark out my stop loss off this trade if it presented, off this 1-minute gap entry, with the stop loss being the swing low and the ultimate target being higher. Then on the Discord, you clearly see me mention I am long. We then end up taking this trade, and let's see the outcome of this position. So there you go. After initially identifying our bias, utilizing overnight price, utilizing the opening range move, and higher time frame narrative, we were able to get a gauge of price being bullish and looking to be more bullish. So then all we simply did was use the golden entry zone, where we then see price showcase 2 bullish sequences off arrays, where we then look for continuation in the market. We then take our trade, and we see price fulfill our targets almost instantly. Beautiful trade, caught on live. Just to set it in stone, double confirmation. 5-minute fair value gap rebalances, zone is valid. 1 minute inversion fair value gap gets disrespected. The timing is now. So in the example I showed you, it wasn't a 5-minute gap that got rebalanced. It was a 1-minute gap that got rebalanced. However, it operates the same way on both time frames. I use 1-minute confirmation looking for an engulfing sequence. Why this is the best entry. Your 5-minute fair value gap gives you the patience play. You wait for the retrace. Your risk is small. Your 1-minute IFVG gives you the precision. You're not blindly entering the zone. The market showed you it's ready. This is the entry that funded my accounts. The complete entry model, FVG entry for reversals, patient, retest confirmation, and tighter risk. IFVG entry for continuation, aggressive momentum confirmed, fast execution. The golden entry, FVG plus IFVG in sync, double confirmation, highest probability. So there you have it. That's the full entry model. Fair value gaps, inversions, how I use them. And when you pair both, you have your golden zone entry. Go back and watch this video with the chart open. Pause the video if you need to mark out your swing points, your fair value gaps. Just simply refine and keep looking for that golden entry zone. If you like this video, comment what entry model you think you're going to be using in the future. To join my community, everything's linked in the description. I'll catch you guys in the next one.